Welcome to the Fear and Greed Weekend Edition, the week that was, a wrap of the biggest stories over the past 7 days. I'm Sean Aylmer. It was a big week for COVID and lockdowns, for Olympians, for the big miners, and of course for the economy. It was a cracking week for financial markets. Sure, much of the world is experiencing an increase in COVID cases, but don't tell investors. Towards the end of the week, Wall Street, several European markets and the local ASX were all trading around record levels. At home, the big three iron ore miners, BHP, Fortescue Metals and Rio Tinto, were all trading at or about their best ever on the back of high iron ore prices and massive dividends either paid or expected. In Rio's case, it announced record revenue for the 6 months to June and a mega payout of $9.1 billion to shareholders. It means that in 2021, the mining giant will return about 13% of an investor's cost of shares in dividends alone. 13%. Normally, that figure is closer to 3%. Fortescue said it would also pay a mega dividend when it reports next month, and major shareholder Andrew Forrest is expected to make about $4 billion from that payout. Not bad. The three miners, who are all top 10 companies on the bourse, led the local market higher, but other companies are doing well too. Industrial groups, some retailers and healthcare stocks, and even some energy companies had a much better week. The banks were solid, and the tech stocks were the laggards, as they've tended to be this year when the market was doing well. On Wall Street, earnings season continued, and with 40% of companies having reported their June quarter results, 90% are beating market expectations. If you don't beat what analysts expect you to make, you're being sold off. Most of the big tech companies, Microsoft, Alphabet, parent of Google, Apple, Tesla and Facebook, reported good earnings, though the outlook statements weren't always as positive as investors would have liked. The one big miss was Amazon. It disappointed and its share price tumbled. China-related stocks didn't have a great week. New rules out of Beijing clamping down on for-profit education groups sent chills through share markets, from Shanghai to New York. Coming on top of the crackdown on tech groups over the past couple of years, investors are wondering whether investing in China is worth the sovereign risk. The aptly named Nasdaq Golden Dragon China Index had a couple of very big falls during the week. By Friday, Chinese authorities were working to reassure investors that the world's second largest economy was still worth investing in, but much of the damage had been done. Oil prices got a kick along late in the week, as did gold prices, which is well and truly back above the $1,800 an ounce mark. The Aussie dollar slowly edged higher through the week to finish at close to 74 US cents, and cryptocurrencies had a rollercoaster ride, falling early only to bounce back, with Bitcoin heading towards $40,000 a unit. In international news, the Olympics, of course, dominated the news agenda. While there were many highlights across the board, and in Australia's case it seemed to always involve water, swimmers, canoers, scullers, there was a more serious side with a surge in COVID-19 cases in Tokyo to record levels. Within the Olympic community, around 200 people have tested positive to COVID, including around 24 athletes. Another bit of international news this week came from a meeting between senior Chinese and US officials, the first since March. It didn't go well. The two sides couldn't agree on much, from human rights in Taiwan to cybersecurity and coronavirus. What did they expect? The chance of US President Joe Biden and China's President Xi Jinping getting together later in the year are fading. Locally, there was plenty of COVID-related news. The Victorian government will force landlords to defer or forgive rent for struggling smaller retailers until the beginning of next year. Fair enough, but the big landlords, the shopping mall owners, aren't happy, and many of us hold those stocks in our superannuation funds. Qantas will join an international travel pass system that will include passengers' COVID-19 vaccination status or recent negative test. Effectively, it will be a digital COVID passport. Bring it on. After being almost non-existent for more than a decade, inflation reared its somewhat ugly head during the June quarter, with prices rising nearly 4% on an annualised basis, the highest rate since 2008. Petrol prices and high childcare costs led the surge. The headline number looked bad, but the underlying rate, which takes out all the volatile items and gives a truer indication of what's really going on, was much better. It was around 1.6% on an annual basis. Given the current lockdown in Sydney and prices data, no one was rushing to forecast much change to monetary policy anytime soon. In fact, economists were more busy redoing economic growth forecasts. Most market economists now expect the economy will contract during the current September quarter, but believe it will rebound in the December quarter, thereby allowing Australia to avoid the dreaded double-dip recession. Homeowners were happy this week. Westpac said it expected house prices to rise 18% across the country this year, including 22% in Sydney. And next year, the country's second largest home lender tips prices to rise another 5%. The bank's views were about the same as National Australia Bank, which also released its forecast this week. NAB said it expected an 18% rise in Melbourne prices this year. Brisbane was tipped to increase by 19.5%, Adelaide by more than 17%, Perth by almost 12%, and Hobart to jump by 23.5%. In corporate news, National Australia Bank will buy back up to $2.5 billion in shares later this month as it works to get rid of all the cash it's built up over the past year. Dividends, buybacks and capital management tools will certainly be a popular theme in the upcoming earnings season. Macquarie Group said it would reduce future dividend payouts to keep enough money in the bank, estimated at tens of billions of dollars. Imagine having that much money in the bank, tens of billions of dollars. Anyway, Macquarie will, so it can buy assets that come up for sale as the global economy recovers. Macquarie's obviously eyeing off a few opportunities at the moment. Origin said it would be writing down the value of assets and paying a deferred tax liability to the tune of $2.2 billion when it reports. $2.2 billion. Imagine owing that much money. What a whopper. BHP did a 30-year deal with Canadian group Westshore Terminals to handle potash, assuming the big Australian goes ahead with its $5.7 billion Jansen mine in Canada. Finding a port is part of the puzzle in deciding whether or not to invest heavily in the commodity, correctly known as potassium fertiliser. Steel Group BlueScope's share price hit its highest level since 2008 after upgrading its earnings forecast for the last financial year. Earnings will be more than $1.7 billion thanks to strong demand and high prices for steel. Now, what I learnt from this story was that hot rolled coil steel prices are up more than 4 times the level of 12 months ago. Fascinating. I'm not quite sure how I'm going to work that one into a conversation, but I'm pleased I know it. Financial services software group Iris knocked back a bid from private equity group EGT. That didn't prevent the group's share price from surging 14% in one session. That suggests there's more to come in this story. Same deal for Australian Pharmaceutical Industries, which rejected an $867 million offer from Wesfarmers and then watched its share price rise. A consortium involving the Ontario Teachers Pension Plan Board and private equity group KKR upped its bid for Spark Infrastructure by 8%. BHP made a successful $350 million bid for a high-grade nickel project in Canada, winning the auction over Fortescue Metals' Andrew Forrest. And healthcare operator Japara unanimously recommended a $380 million takeover offer from the not-for-profit group Little Company of Mary Healthcare, also known as Calvary Healthcare, in an all-cash deal. There certainly is a lot of corporate activity going on at the moment. Now I get to the point in the program where I go through the biggest story of the week, the sleeper story, the most remarkable story, and my favourite story. The biggest story of the week was, once again, the COVID crisis in New South Wales. By the end of the week, 8 local government areas were in hard lockdown. The army was set to patrol the streets to ensure people did the right thing, and the number of new daily cases was being counted in the hundreds. Commonwealth Bank forecast that 300,000 jobs could be lost, and governments are now talking about acceptable levels of COVID in a highly vaccinated society rather than zero tolerance. Canberra boosted its support packages for individuals and businesses, and there seemed little reason for optimism. But I'm an optimistic sort of fella. This bout will end, and Greater Sydney will come out of lockdown. At least Victoria and South Australia ended their hard lockdowns this week. Vaccines are being administered at a 200,000 per day pace. The economy will bounce back after it's all over. Overseas travel will resume, migration will recommence, and we will all get to see our workmates and schoolmates face to face again, sometime soon, hopefully, maybe. The sleeper story of the week involved the Commonwealth Bank and Apple. You have to stay with me on this one because it gets complicated. About 80% of all tap-and-go payments on smartphones are done via iPhones. The technology involved uses a near-field communication chip. Apple only allows Apple Pay to access the chip. Other apps, the Commonwealth Bank's app, for example, is prevented by Apple from accessing the chip. Commonwealth Bank's boss, Matt Comyn, this week said the government needed to regulate players like Apple because they were free-riding on the bank's investments in payment systems, and the tech giant was being anti-competitive, not allowing Commonwealth Bank and others to access the chip. Less competition, worse outcome for customers. This story will be much bigger news over coming months. The most remarkable story involves second-hand cars. Prices have jumped by about a third over the past year. They're higher, not lower, and will continue to rise into next year, according to ratings agency Moody's. It's because manufacturers are struggling to get new cars into the country due to the global shortage of semiconductor chips. Buying a car as an investment? Remarkable. My favourite story this week, of course, was the Olympics. I'm in lockdown, so my viewing of the games is broadly uninterrupted now, apart from the pesky homeschooling thing. My highlights include the incredible grace of Simone Biles, the world's best gymnast, who pulled out of the games for mental health reasons, the Fijian rugby team's gold medal, the success of six-time Olympian Jiang Fang Lei, the Australian table tennis veteran who made it further in the competition than ever before, and of course, all those medals, gold, silver and bronze, won by Australians. Moving on to this week's interviews. On Monday, Cindy Leung from trading platform CMC Markets was my guest, and we spoke about investing overseas. In particular, we looked at the volatility and opportunities in the United States, Europe and Asia. Sonia Stewart, the CEO of the Law Society of New South Wales, was my guest on Tuesday. We chatted about a rather incredible statistic. There are now more female solicitors than male solicitors. Wednesday's chat was with Bill Bovingdon, Chief Investment Officer at Altius Asset Management. Among other things, we looked at whether green investing meant a compromise on returns and what it takes for companies to qualify as being green. On Thursday, I spoke to Alastair Doak from Mazda Australia about the shift to electric vehicles, which is gathering momentum around the world. And finally, yesterday, I spoke to Ben Walker, the founder and CEO of Shopper. Shopper is behind many of the digital billboards inside shopping centres and the like, and the conversation was all about how digital advertising and data is changing the industry. So it was quite some week. If you want to listen to any of the interviews or indeed any of the shows over the past week, all are available on your favourite podcast platform or at fearandgreed.com.au. That's pretty much it for this week. Don't forget to join us tomorrow for our chat to Andrew Hunter, Head of CPA Australia, about recovering from the lockdowns. I'm Sean Aylmer. Have a good Saturday and a great weekend.